Hello, this is Joe Haggerty from Hardenbergh Insurance Group, and today I'm going to be doing a webinar on cyber liability. So first, we're going to talk about what is cyber liability. From a historical perspective, it's third-party liability coverage for wrongful acts arising from the performance of technology services for things like software consulting, systems integration, website design, online services and contents, and online commerce. The contemporary meetings, not just the technology errors and omissions, but also network security liability, privacy liability, media liability, regulatory and defense penalty, first-party cyber extortion, first-party privacy breach response, first-party business interruption, and crisis management. If you notice, the first 5 are blue and the last 4 are in black. I differentiated the colors. The first ones are third-party coverages, and the last 4 are first-party coverages. And when I say third-party, I mean losses sustained by other parties. And when I say first-party coverages, I mean losses sustained by you. We're going to differentiate between those as we go along in the presentation. So why is cyber liability so important now? Well, for many years, there's been awareness that companies should be accountable for the private records that they handle. HIPAA was passed in 1996 with a privacy rule that went into effect in 2003 regarding private healthcare information. Since then, 47 out of 50 states have also amended their state laws or codes to address how companies and state agencies need to respond to leaked personally identifiable information. Most state laws say that if you lose records of a state resident, you must notify that state resident as well as the specific state agency that handles that. And these rules apply not just to technology companies, but to any type of business. It's also not limited to just electronic information. Most cyber liability policies also respond to data breaches of paper records. So, for example, an employee goes home with a client file that has personally identifiable information in it. That information is stolen or lost. That would typically be covered under most cyber policies as well. And as I mentioned, all businesses really have a cyber liability exposure. However, some of the following here have a more pronounced exposure than other businesses, and those include healthcare providers, banks, law firms, accountants, hotels, retail stores, schools, public entities, charitable organizations, mortgage brokers, insurance agents, restaurants, and any other business that maintains records of personally identifiable information. So what are the key third-party coverages? The coverages for losses sustained by other parties. The first one we discussed, technology errors and omissions. That's an error and omission in the performance of technology services. Privacy liability, failure to protect private or confidential information. Security liability, failure of a network and information security to prevent the transmission of computer viruses. Media and content liability, be libel, slander, and other forms of disparagement with respect to display of material online, as well as infringement of a copyright by your website content. Regulatory actions brought by state or federal agencies to enforce privacy regulations. And what are the key first-party coverages? And this would be for losses sustained by you. Cyber extortion. That's the cost to investigate, negotiate, and settle threats made against the insured related to intentional computer attacks. Privacy breach response. This is expenses for breach response services such as notification, credit monitoring, and identity and credit repair. Business interruptions. Interruptions in business due to breach of a company's network. Crisis management. Expense of retaining a public relations firm to help mitigate damage to the insured's reputation and brand image. So these 4 things are all expenses incurred by the insured in the event of a data breach. And I'm going to go into claims examples for each one of these to try to give solid real-world examples of what these claims could look like. This next here is just a sample of a typical insurance policy. This one happens to be the XL Pro 2.0. Typical limits, you see usually a per claim limit of $1 million. Typically, we don't sell limits below $1 million, although they do exist. Limits can be much higher than $1 million, but in this particular policy, just had $1 million limit, subject to a $3 million aggregate, meaning that for any given claim, they'll never pay more than $1 million, and in any given policy term, never going to pay more than the $3 million. And then you can see below that, they have the different insuring agreements or the different sublimits available for some of those first-party coverages that we talked about. This is, like I said, this is just one particular policy. Each policy is a little bit different, but they do have similar insuring agreements. So the first claims example I want to give is a technology errors and omissions claims example. So the insured is a software design company. They're hired to integrate the operating system to their accounting system. Due to a programming error, the system is disabled. The operating system is down for a week, and they lose substantial revenue. Another example is the insured is hired by a client to integrate their HR and payroll systems. The insured falls behind in delivering the work and misses key milestones. They allege that it was due to changes initiated by the client. The client fires them and files suit for loss of profits due to disruption. So these two examples are an insured fails to provide, or they make an error and omission in providing technology services. So these type of claims would apply to insureds that are in the business of providing technology services. Network security claims example. An employee of ABC inadvertently downloads a virus that spreads to other files on their network. The client downloads information from ABC's website, allowing the virus to spread and cause widespread loss of data, and the network shut down. ABC's client sues ABC for damages caused by the lost data and for economic loss from the shutdown. So this is an example of a network security claims example. Again, this is going to be a third-party coverage. Privacy liability. An employee of XYZ has a company-issued laptop computer stolen from their home. The laptop contains personally identifiable information of customers. Customers sue XYZ for their failure to protect their personally identifiable information. This is another third-party claims example for a privacy liability type claim. Media liability. ABC updates their website. The website now contains a new logo for a new product. Another company sees the website and files a trademark infringement lawsuit against ABC, alleging it is very similar to their own trademark logo. The lawsuit seeks damages as well as an injunction to stop using the trademark. So again, this is a media liability claims example. And regulatory and defense penalties claims. XYZ system is compromised by hackers. Hackers obtain personally identifiable information of XYZ's clients. They're fined by a state or federal regulatory body for failure to safeguard the information. Now I'm going to move on to claims examples for some of those first-party coverages that we talked about. The first one being cyber extortion. The operating system of ABC company is completely disabled. The president of ABC receives an email from an unidentified source stating that they will destroy all the data in the system if they do not receive $25,000. So this would be an example of a cyber extortion claim. So this is someone trying to extort money from you, holding your system at ransom, or or some personally identifiable information at ransom. The next one is a first-party privacy breach response claims example. So XYZ's operating system is hacked. Names, addresses, phone numbers, and credit card numbers of 50,000 customers are compromised. XYZ incurs $350,000 in expenses for notification of customers, as well as ongoing credit monitoring for their customers. Some people aren't aware that the notification costs can be so costly, but in this particular example, we're saying certified mail of $5 each for 50,000 letters. That would be $250,000, with $100,000 paid to a credit monitoring firm. So you can see that these expenses can really add up quite quickly, and this is before there would be any third-party losses. First-party business interruption claims example. ABC's server is infected by a virus and shuts down. As a result, they're unable to process online orders for an extended period. They estimate that approximately $500,000 in online sales would have been conducted during the shutdown. They operated at a 10% profit margin, so the net income lost would be approximately $50,000. A first-party crisis management claim example. The chief operating officer of XYZ International has his laptop stolen. The laptop has 100,000 customer records on it, which contains personally identifiable information. Due to the size of the breach, they engage a public relations firm to restore customer confidence and mitigate negative publicity. The cost to engage the firm was $125,000. Again, this would be an example of a crisis management claim. So 47 states, the District of Columbia, Guam, Puerto Rico, and the Virgin Islands have enacted legislation requiring private governmental or educational entities to notify individuals of security breaches of information involving personally identifiable information. Security breach laws typically have provisions regarding who must comply with the laws. What the definitions of personally identifiable information are, usually it's a name combined with a social security number, driver's license, state ID, or account numbers, and what constitutes a breach, and what the requirements for the notice are. So in conclusion, this is a coverage that was historically purchased by technology companies. But now virtually every company that handles any personally identifiable information has an exposure. And key insuring agreements typically include technology errors and omissions only if you are providing technology services. If you're not, the other insuring agreements that you would look for are security liability, privacy liability, media liability, regulatory defense and penalties, cyber extortion, privacy breach response, business interruption, and crisis management. What's very important is that not all policies are the same. So some policies might only have security and privacy liability. They might not contain media liability, regulatory defense and penalty, and they might not contain any of the first-party coverages, whereas a very broad policy will include insuring agreements for the security and privacy liability, media, regulatory defense, and all of the first-party coverages. That's why it's very important to have your agent look this policy over, make sure that all the appropriate insuring agreements have been purchased, and that there's suitable limits in place for each one of those agreements. And that concludes the presentation. Thank you very much.